Welcome to the Life Unlimited podcast with Larry Heller. You deserve complete financial advice so you can confidently live your life your way, for life. Now, let's get into this week's podcast episode.
Hello and welcome to another Life Unlimited podcast with your host, Larry Heller. Today we have a guest. This is Chris Coates, an expert advisor specializing in business transition strategies, particularly focusing on ESOP ownership transactions. With a rich background spanning over 30 years, including his tenure as managing director at Accenture, Chris brings a wealth of experience in deal shaping, negotiation, and operational management across diverse industries, such as life science, utilities, consumers, products, financial services, health, and public service. So we're going to be talking about ESOPs and a whole bunch of other fun stuff today. Larry, take it away.
Thanks, Matt. Chris, thank you so much for joining us today.
Thank you for having me.
Yep, we're going to talk a little bit about ESOP. So before we even kind of get into this, I mean, a lot of our audiences may have heard the word ESOP, but they have no idea either what it means, what it does, why they should be considering this. Is it a good thing, a bad thing? So we're going to cover a lot of ground out there. So, Chris, why don't we start really right off at the beginning? What is an ESOP?
All right. Well, yeah, an ESOP is an employee stock ownership plan, and actually you mentioned it, that a lot of people don't necessarily know what they are. And so thank you for the opportunity to share some information. An ESOP is at its core retirement benefit for a company's employees. It's a mechanism for a business owner to sell their business separate from a third-party transaction or selling it to like private equity. Ultimately, you're selling your business to a retirement benefit for your employees, and the government provides incentives for business owners to use this in order to basically help bridge the wealth gap by providing broader access to equity for the employees. So I'll stop there.
Okay. Yep. So the employees actually then own shares, or the retirement plan owns it and they own shares of the retirement plan? How does that work?
Well, yeah, it's an important nuance. It is the retirement plan is what owns the shares. It's a retirement trust. So the employees get shares in the business, but they're beneficial owners. They're not direct owners. So as the ESOP is set up, and we can get into the mechanics in a little bit, as the ESOP is set up, the shares will be allocated to the employees over time. And so they build up ownership in the company, but it's in their retirement benefit plan. And so basically it helps them retire better, when that time comes.
Right. So they're not kind of making decisions on running the business and how they're getting just a piece of the business financially in shares, and hopefully that goes up. And then at some point in time, they could cash out and get a retirement benefit. Is that kind of how it works?
Correct. Yeah, they're not, and that's a misconception that a lot of people have. They do not have operational control, as they're not, getting direct ownership and having say in how the business is run. It really is the company transitions control to the retirement trust. Operationally, the company basically operates the same as it did before the transaction, and they just get shares in their retirement plan so that when they're ready to retire, it's sort of akin to a 401k, except it's shares in the business that they work for as opposed to a diverse, fund. And so, but they will get distributions when they hit retirement age that allow them to get income in addition to their other retirement income.
I know we may cover this later, but just thought off the top of my head. So do all employees have to participate, and how do you decide how much shares each employees get? Is it equal amount? Is it different amounts?
Well, everybody does participate. Everybody has the opportunity to. That's not to say that everybody will participate. There's requirements they have to meet to become eligible, which is typically been with the company a year, minimum 21 years of age, and working at least half time. So that's sort of the eligibility side. And then there's vesting, which typically is 3 to 5 years. If you have a transient population, they may never participate in the ESOP as they will not meet those requirements. Everybody has the opportunity to participate, though, and when they do become eligible, the way that the distributions occur are typically based on total comp. So it's basically the higher compensated employees, the more key employees will generally get a larger allocation, though everybody who is eligible will receive an allocation based on their compensation.
Right. So they're not paying for anything. They're actually just getting this benefit.
Correct. This is, a benefit that is done to the employees by the business for their benefit. And it's, that's one of the beautiful things about it. It can be very good for retention and talent attraction because it's an additional benefit that people are not paying for, and it can be material for their retirement.
Right. So just so the government is actually paying for this. Is that how it works?
And this may be a moment to sort of describe how they work and what the incentives are. But yes, the government is sort of helping business owners, incenting business owners to do this for their employees' benefit, again, to help try and bridge the wealth gap by creating this access to equity. The 4 incentives that the government has set aside for ESOPs, and this is part of ERISA. ESOPs were created in the 70s under ERISA. They've been modified a bit in terms of legislation, but ultimately it's a product of Congress trying to incent business owners to do this, and that's why they're overseen by the DOL and the IRS because of these benefits. But first off, it's the only benefit plan that the government allows you to borrow money to set up. As such, the way it works is a company will take out a loan on the balance sheet. Those monies get loaned to the trust because the trust has no assets. Those monies are then used to purchase the shares from the owner. So in that 3-part transaction, the owner is getting money for their shares. The trust is getting the foundation for this benefit plan so that they have the shares to allocate out to their employees. Typically, a bank is not going to loan you full value for your company upfront. And so in addition to the lending, if you're doing 100% ESOP, you're also getting a seller note. So the company is pledging to repay the owner for the shares over time after the bank debt is paid down. So again, first incentive is the only benefit plan that the government allows you to borrow money to set up. The next 3 are tax-based. So if you're a C Corp, and you have to do it as a C or an S, and you can switch at the time of the transaction, a C Corp, the owner can sell their shares to an ESOP and defer the capital gains on that sale till stepped up at death. So as you know, your state and my state, New York and New Jersey, in a low basis company, if you're selling a company, 30% of that the proceeds could go to the government. That can be avoided with an ESOP as a C Corp. In addition, as a C Corp, the company can actually deduct the contributions to the benefit plan on an annual basis. And those contributions are tied to the servicing of the debt. So basically, you're making a contribution to a benefit plan, which is then used to repay the internal debt. That becomes an additional tax deduction. So it's cash flow positive. So as a C Corp, owner gets a potentially tremendous tax benefit. The company gets a moderate tax benefit. If you're an S Corp, conversely, the company can operate as a de facto tax-free entity. S Corps, many of the listeners will know that, the company has to make contributions to their shareholders to cover for their tax obligations. Well, an S Corp ESOP doesn't pay taxes. So that basically becomes a for-profit company operating as a tax-free entity. So those are sort of the 4 incentives that they're helping owners opt in for this, or at least become aware of it as a way to both monetize their business, but also get a benefit for their employees.
And there was one more, I think you said 4.
So that's the 4. So it's the ability to borrow money, the 2 tax incentives as a C, both for the owner and the company, and then the tax incentive as an S corp.
Okay.
And typically, a lot of our clients will do the transaction as a C corp if that's available to them, and defer the capital gains, and then eventually switch to S to become a tax-free entity de facto, because it's just that's pretty magical as a company being able to operate and not pay income taxes.
So the S corp can't defer the capital gains?
No, if you're doing it as an S, then they say that's that does not tie to the capital gains deferral. There is some movement in Congress that they're trying to get a little bit of that in play, but that's not. That's currently, it's only as a C corp you can defer the capital gains, and then you have to switch to S subsequently to basically become a de facto tax-free entity.
Okay, gotcha. So let's kind of go back to the kind of one of the reasons, like, why would a business owner want to do this rather than sell to a third party, or you said private equity? Why would somebody, what are the reasons why they'd want to do this ESOP?
Well, there's a couple of things. Obviously, the tax benefits may help you end up better financially. If you can defer the capital gains on the sale, that can be a material shielding of assets. So that's why the government is using those as incentives. The other things that might drive someone to want to consider an ESOP, many of the owners care about their employees. They have loyal employees that have been with them for 20 years, and they want to do something. They feel they've made enough money, and they want to be able to give back to some of their employees. An ESOP is an elegant mechanism to do that. As Matt mentioned, I spent 30 years with Accenture. I had access to stock options and RSU grants that allowed me to get equity in the company. Mid-market companies, private mid-market companies don't necessarily have access to that or as many mechanisms. So this sort of creates something that you can give to your employees. The other thing, if you sell to private equity or a third-party strategic, they're going to want to tell you how to run the business. They're going to want to say, an ESOP trustee doesn't necessarily care how you run the business. Operationally, the business will continue as it did prior to the transaction. The trustee's fiduciary responsibility is to make sure that you've set up a legitimate benefit for your employees. So as long as that purpose served, they're not going to say how you run the business. So for people who want to stay involved, people who are not ready to fully step away but want to monetize their business, it can be a good mechanism for that, and also create the incentive for the employees to start behaving like owners. They're becoming owners, and so if you want to work on your succession plan, you're going to create incentive for people to basically get more invested in the company. So those that have the wherewithal and the desire to maybe become the next leadership team, there's incentive for that. So patience, not wanting to give up control, wanting to help out their employees. Those are some of the reasons that people might use it.
Right. Does the ESOP have to own 100% of the company? In other words, let's say you had two partners. One was the 80% partner, the other was 20%, and that 20% owner was younger and kind of didn't want to sell their shares into the ESOP. Can you do that, or it has to be 100%?
Nope. ESOPs are actually very flexible. You can do any percentage that you want. There's rules around the capital gains deferral. The ESOP has to get at least 30% of the shares of the business in order to qualify for the capital gains deferral. But absent that, You can do it for less than 30 if you just want to create a benefit and take some chips off the table. But if you want to do 30%, 40%, anything under 50 will allow you to retain control. So depending on the partnership scenario, if you have a couple of junior partners who want to stay involved and benefit in the growth of the business, you can do that. It just becomes a question of do they want a control stake? Do they, but very flexible.
So are there different types of companies, industries that are better fit for ESOPs than others?
ESOPs are really industry agnostic. That being said, there are ones that you don't see them as frequently. Number one, even though it's a legal construct, law firms do not do ESOPs. Technically could be feasible, but they're just not done. You do see it in medical practices, which is a similar type of arrangement where you have a partnership and there's rules around ownership by professionals. But like it's same thing with a PE transaction with a medical practice. You'd have to set up a shared service for 75-80% of the revenue in EBITDA, and do the ESOP on that, and then have the ownership of the delivery of medical services done by doctors. But we see it in obviously sort of core manufacturing. That's sort of a natural and where they sort of started. But professional services, we're doing a lot in the architects, engineering, and construction space. IT contractors. It really does run the gamut, and it's the limitations are hyper growth companies. You're not going to do it. ESOP trustees are conservative. So like a cybersecurity IT company, chances are you're not going to get the valuation that you would, based on your growth trajectory. It's not for business in distress. Again, at its core, it's a retirement benefit for the employees. So the DOL and the IRS are going to say, if this is a company that may not endure, why are you going to set up a benefit that may go away? So highly cyclical businesses sometimes can be a struggle. Not necessarily you can do it, but again, it's a question of will you get the valuation that you're looking for.
And what about size, employee size? Is there something that you see more often, typical, or it's just all over the place?
Well, our floor for what we think a transaction is doable is $1 million in EBITDA and up. Now, that is on the small side. It may not be the wealth fit for the owner because you may not be able to get bank lending. It's all about cash flow. So you may be doing it all seller finance, but that may be okay. But so $1 million in EBITDA and up is sort of where we think is sort of the floor for a transaction. 20 to 25 employees is the base, and that's really for anti-abuse rules as an S corp. Below that, it sort of starts looking like a land grab for senior management, and it's not. Again, it's supposed to be a retirement benefit for a broader base, and so that becomes limiting. But we've done them as small as that. Our highest transaction to date is $240 million enterprise value. Our wheelhouse, I would say, is in the sort of $30 to $60 million valuation range. And the employee count can run the gamut from 50 to 125. It just depends on industry and business.
Right. Now, do you see the valuations a little bit lower than you would on a traditional sale or a PE sale?
Well, by regulation, the trustee cannot pay more than fair market value. So fair market value is a range, obviously, but the trustee can't overpay for the business because then it hurts the participants who are the beneficiaries of the trust. But and excuse me, I just had a little stop for a second. You get the question again. It was so.
Question was, so is the valuation, like there's a going rate for a multiple of EBITDA for whatever
Yep.
industry, would that be the number that would be used? I know private equity is obviously probably a little bit higher, but would that be used, or is this, are there certain restrictions making this a little bit less of a valuation, but an owner is now transitioning it to their employees? Or is it basically the similar valuation?
And there is, so let's get started again. So yeah, so well, by rule, a trustee cannot pay more than fair market value for the business. Again, it's a retirement benefit, and so they're not supposed to overpay because it hurts the beneficiaries.
Mhm.
They are not, as a result of that, they're not allowed to pay a strategic premium. So if you had a third party strategic or a PE firm that was trying to purchase the company to maybe eliminate a competitor, or could consolidate shared services, and so is willing to pay a premium, a trustee can't do that. So you are going to
but you'd still
than
be able to get market value. You're not taking a haircut by doing an ESOP versus a traditional sale.
the trustee will be a little bit conservative, but no, you're really not taking a haircut. It's really what a financial buyer would pay. So we're seeing in this market, for good sized companies, you can get, 6, maybe more times EBITDA. Again, it depends on the industry and the size. A smaller business is going to have, struggled with the cash flow to service the debt, and so they may not get as much. But a good 5.5, 6 times EBITDA for a strong business is there, and you can go higher for specific businesses.
So speaking of the market, is current interest rates and the current economy having an impact on ESOPs right now?
A little bit. In terms of valuations, I think less so. Whereas a couple of years ago, you could have gotten a higher premium from a strategic or PE. Some of those, the interest rates have sort of, gotten rid of some of those extreme multiples. And in ESOP, I think the overall multiple is fairly consistent with what you could have gotten a couple of years ago. Where it's impacting is the upfront lending. So, a couple of years ago, you might have been able to get 3 times EBITDA for lending with an overall valuation of, let's say, 6.5. Now you may get the same valuation, but you're probably only getting 2 times EBITDA for upfront lending. And so the corollary to that, though, is that you're probably getting more in the seller note. So if you're getting mezz interest rates on the seller note, now those are going to be higher than they would have been a couple of years ago as well.
Got you. So now if you put this in place, and most companies have 401k plans, does an ESOP, impact having a 401k plan?
You would not get rid of your 401k plan, as part of doing an ESOP. Typically, it's going to be an additional benefit for the employees. Part of that is you're not going to want to take a diverse retirement benefit from someone and replace it with a non-diverse benefit. That's just, basically a formula for a lawsuit. But some people will, maybe adjust their match. So let's say you have a 401k and then you have a rich match with it. They may say, okay, I'm going to we're still going to do the 401k, but maybe the match will then either all or in part go fund some of the, annual contributions to the ESOP. So that all comes out with the modeling that you have to do to make sure to see, what makes sense in terms of ESOP construction.
And the way this works would be, let's say you do an ESOP, you put it in place so the employees or the owners, do they have to wait until the company is sold, or if they are fully vested and leave, they would be able to get their share? And where does their share come from?
I mean, an ESOP, is a sale. I mean, ultimately, it is the sale of the business, and it's meant to promote sustainability. So, it can continue on and just, service multiple generations. We have, multiple clients that have, longstanding ESOPs. If the company is sold, And then the new owner has a decision point about, do they want to keep the ESOP, or do they want to buy it out? Typically, it wouldn't get bought out unless it was getting paid as a premium, and that benefits the participants. So that's a good thing. If someone leaves the company, it always depends on how your plan documents are written, but typically, the company will want to buy back those shares and not have an incentive for someone who's no longer there. And so those would get bought out over time and repurchased by the company to either be retired or recycled and brought back into the plan. And then other than that, if someone retires, basically when they hit retirement age, they will start drawing, the shares will get sold and they will get, income for their retirement.
So, so an ESOP's not going to impact a company trying to, sell somewhere down the road.
Oh, some people think that it makes it more complicated to sell. We don't think so. It's just a process. Again, you have to either wind down the ESOP, and basically the monies for the people have to go into something. They have to roll it into some other qualified retirement plan. Otherwise, they pay the taxes on it.
Mm-hmm.
There are some. Again, it depends if you do. The ESOPs are very flexible. If you're doing a full, it's pretty straightforward in the sale. If it's a partial, then there may be considerations around, again, is someone trying to buy a full stake, a partial? But again, it's just a process. You have to either keep the ESOP going forward or unwind it and avoid, make sure there's people aren't getting undue tax impact.
Right. So the trustee of the ESOP would be the one responsible determining how the ESOP is invested.
Well, there is some cash that can require investment, but ultimately the primary investment is the shares in the business that you own. Again, this gets into the nuance with a minority S transaction. If it is like a minority S transaction, then there will still be shareholders out there. They will get distributions annually, so will the ESOP, and so cash will start building up in the ESOP.
Mm-hmm.
Some of that is actually you're going to want to make sure you have liquid for repurchase obligations or invested in safe investments, so that when you have retirement spikes, you can repurchase the shares and not create a cash drain. But
right, that's where I was going with the would there be cash that would build up in the ESOP that would be managed, or so the business is not caught by surprise in case you have a number of people retire at the same time?
Correct. That's and that's something that you hit about 7 years into an ESOP. You have to start thinking about your repurchase obligations.
Mm-hmm.
In the early years, there's just not enough allocated out to have to worry about it. But as you start getting material balances in people's accounts, if you have retirement spikes, that will draw down cash, and so you want to plan for that. But that's something that you have advisors. Your CFO just has to pay attention to it, so that you can. It's just planning for the future and, when you're going to have those cash needs.
Okay. So just to summarize, kind of big picture advantages and disadvantages of an ESOP are?
The disadvantages, I would say, if it's a company that's in distress and looking for an exit, not really the right vehicle. If it's someone who's looking to exit quickly, not the right vehicle. If the ultimate goal is most money in the now and someone's willing to pay a premium, then an ESOP's not the right answer. But for someone who is looking to take care of their employees, looking to monetize their business in a flexible manner and tax efficient manner, in a way that doesn't give up control. If they're patient, again, you're going to have to wait out the bank debt and the servicing of that before you're going to get, your seller note repaid. So, it's patience, wanting to take care of your employees, you know, not looking for the last dollar, someone who cares about the name on the masthead, you know, not necessarily having a third party buy it, move it, break it up. You know, those are the sort of the fact patterns that fit. And typically it's a company with a good culture. You know, usually the owners who want to look at ESOPs, the bones of that sort of culture are there, you know, with great place to work,
Right.
programs, et cetera.
Great, Chris, this has been great, very educational. I'm sure a lot of our audience out there has got a little bit of understanding of how an ESOP works and whether it may be of interest to you. So if somebody wants to learn more about it and see if this is a possibility for them, Chris, where can they get a hold of you?
Well, they can reach me at Christopher.Coates, Coates, at sesesop.com. And, you know, we're happy to get into more detail about how they work, you know, where they might fit and where they might not, and, you know, talk about specifics.
Great. Thank you so much for joining us today, Chris.
Thank you for having me. It's been fun.
If you want to make sure that you can provide great benefits for your employees, save on taxes, and truly help bridge the wealth gap that is happening in the United States, and ESOP is a fantastic way to go ahead and do that. So please go to www.sesesop.com and also go ahead and find Chris on LinkedIn. All you have to do is just go ahead and type in Chris Coates and he will show up immediately. And of course, if you have any other questions about how this can plug into your overall financial plan as a business owner or as an individual, please make sure that you reach out to Larry at Heller Wealth Management to find out more. So for Larry and Chris, this is Matt Halloran, and we'll see you on the other side of the mic very soon.